All right, joining us now for a roundtable discussion on the 2019 rally heading into 2020 are Chris Versace, Chief Investment Officer at Thematica Research, and Joel Griffith, Research Fellow at the Heritage Foundation. Thank you both for joining us today. Chris, we'll start with you. 2019 was a huge year, obviously, for the stock market. The three major indexes, the S&P 500, Dow, NASDAQ, all skyrocketed north of 20% up. NASDAQ up more than 35%. So let's look back a little bit before we look forward. What drove these gains? What was the biggest factor in 2019?
Well, I think if you look at the cadence of the gains throughout the year, the first quarter was off very strongly. Then the markets, continued to melt higher a little bit in the second and third quarter. But it was really the fourth quarter that things exploded, and really in the last month of the year. So what were the factors? If you think back to the late summer, the market, where there was some concern in the marketplace about whether the U.S. economy would slip into a recession. Clearly, that was no longer a question in the U.S. economy, even based on today's data from IHS Market, continues to look like one of the best economic houses on the block. There was concern about trade. Clearly, with the U.S. trade agreement with China being inked, phase one on January 25th, that has fallen by the wayside. So a number of things have really come off, allowing us to be, risk on in terms of the marketplace.
I want to turn things your way as well, Joel. When we think about where many of the banks had actually predicted major averages would end 2020, I mean, we're just a stone's throw away from some of those markers, at least for the S&P 500, where we had seen pretty much a consensus of 2020 ending at about 3,300, maybe 3,350, netting somewhere in between there. With where we are right now at 3,250, 3,260, what does that spell out for 2020? Slow growth, normalization, if we call it that? How would you classify this?
Well, I think that we have an opportunity going into 20 to see a resumption of the elevated growth that we saw following the passage of the tax cuts a few years ago now. I think we had a lot of trade concerns that were weighing on the market. There's no doubt that was a drag on economic growth, but we saw that a lot of the worst fears heading into last year were not realized. And now we see that some of the actual tensions that were there, such as the trade disputes, those appear that they're going to be lightening up come January, when the president says he'll be signing an agreement with China. If that happens, I think that we are going to see a resumption of growth, and we're going to finally see businesses feel more comfortable with doing longer-term capital investments. And that's all important because it's those capital investments that can actually accelerate growth even beyond 2020.
Chris, sticking on trade, now that we've essentially gotten to a point where a phase one trade deal exists, is going to be signed soon, do you think investors are going to treat phase two, phase three, phase final the same way that they reacted to phase one, or has this largely been priced in, the idea that a trade deal is essentially here already?
Well, I think that the phase one part of the deal is effectively priced into the marketplace. That was, again, one of the driving factors of the market rally over the last month. I think that once we finally see what all the details are, we'll have a much better setting, and then we'll start to understand what the agenda is for phase two. I think the one thing to point out, though, is going to be what is covered in phase one is really going to shape what we hear during the upcoming earnings season as companies start to give guidance for the March quarter and in some cases for 2020. Remember, EPS expectations for the S&P call for roughly 10% EPS growth. This is exactly where we started the year last year. And while I don't expect that we will be flat in terms from an earnings perspective the way we were in 2019, the real question is somewhere between 2, 3, 4%, 8, 9%. What is that earnings growth going to be?
Chris, staying with you for a second here. You got two animals behind you. You got a bull, a bear, and then you got the Batmobile up there as well. We'll get to that a little bit later. But if we're thinking about the animal spirits here, and you got a ton of books as well. So if you think about the animal spirits here right now, are you seeing more CEOs right now lean bullish or bearish, given the fact that we may have the early stages of a phase one deal already netted out, yet we still have some uncertainty that's on the table that could still impact their business, and in turn, if there is a trickle-down effect to the consumer, which is the massive bread and butter of this economy, that could potentially impact and pass through to them as well?
Brad, let me see if I can remember all that. I think the answer is yes. I think it also speaks to exactly what Joel was saying, that as we move further on trade, that we will start to see capital spending, pick up again. That's something we haven't really seen given the uncertainty of the trade factor. So I do think the economy will continue to perk up. In fact, if you look at some of the New York Fed's forecasts for the March quarter, they're up a couple, like 1.2 from the December quarter up to 1.3, 1.5, 1.6% for the March quarter. So I do think we'll see that resumption. Again, positive vector. The only real question is going to be how much is the escape velocity that we'll be seeing.
Joel, let's turn now to monetary policy. Of course, the Fed cutting interest rates 3 times in 2019. What are you looking for in either a commentary from Fed Chair Jerome Powell or actual action on monetary policy this year?
Well, I think that we need to look at the actual impact that Fed policy has. Is it monetary experimentation that has the bigger impact, or is it these rate cuts? I would argue that in reality, the Fed has very limited control over long-term interest rates. And if we're focused on that, we're missing the boat. It's not what interest rates are at that's going to drive economic growth. If you look at Japan, for instance, Japan has had negative interest rates for a number of years now, and they are stuck in a quagmire. I think instead of relying upon the Federal Reserve to channel economic growth or to speed up economic growth, we need to keep our eyes on what we know produces long-term wealth. And it's not manipulation of the money supply. It's not experimentation. What it is allowing people to keep more of what they're earning and incentivize investment. And we have made big steps forward. There's a lot more work to be done, but that's what I'd like to see the focus on in the coming year.
Stick with you, Joel, here, because we had a lot of economists calling for a recession after we had seen the inversion of the yield curve, and after we were sputtering in that territory for a couple weeks. We essentially looked at the responses and calls from economists for a recession impending over the next 18 to 24 months. Do you think that's something that we see earlier rather than later? Does it come in 2020, or should we look for it in the next year, perhaps?
Well, I think we need to keep in mind that economic expansions do not die of old age. That's not me that came up with that phrase, but they don't die of old age. We often sabotage that through policy. The fact is we are in a record long stretch now of 10 years, but there's no reason why that has to end just because we are in year 10. This last year we saw a slowdown. The slowdown in large part was created because of our trade disputes. Well, we have weathered the storm and now we can live on. So I'd say let's not sabotage this. I'm not going to make a prediction that we're going to go on another 2 or 3 or 4 years. It's hard to prognosticate. But there is no reason that it has to end this year just because we're in year 10. I think the fundamentals are in place to continue this, but there are threats, one of the threats being trade, but also longer term, the government spending, the large government debt that we're running on a structural basis, that does threaten long-term growth. That has to be resolved, and I hope that's something that our legislators will do in the coming years.
We got to leave things there. Chris, 5 words or less, recession 2020 or no?
No, Fed does nothing, election 2020.
All right, that was more than 5 words, but we'll let it slide today. Chris Versace, Chief Investment Officer at Thematica Research, and Joel Griffith, Research Fellow at the Heritage Foundation. Gentlemen, thank you so much for joining us here today.
Thanks, fellas.
All right.